Hey, Dr. Barrio, your mortgage doctor. I am here and I am ready to put in the work.
Might need that fire truck to come and get me. Money and water, 'cause this boy is fire. Has got a hold of me.
Today, we're going to talk about debt to income ratio. I just want to make sure that everything on here is clearly understood so that you can calculate your own DTI. There are calculators. If you would go to my website, thathomeloan.com, you will find there some mortgage calculators as well. We'll make sure to put it in the description. Without further ado, let's jump on in to the DTI discussion. So DTI is your debt to income ratio. It is a ratio that is used to determine if the lender feels that you can afford the mortgage. There are a number of DTI ratios depending on the type of program, and there are lots of factors that are involved. Your DTI is calculated by taking the expenses, dividing it by the monthly salary. In this case, we have a monthly salary of $10,000, and multiplying that times 100 to get the actual percentage. So in this case, a $1,600 in expenses is 16% of your gross salary, not your net, your gross. So you take the expense, divide it by the salary, multiply it times 100, and you get the DTI. In this case, we get 16%. I'll just do a general, I'll speak in general as we go through about the DTI. There are a number of DTI ratios that's used depending on the program. It's always better to get with a loan officer for your specific program to find out exactly what the DTI is required. In some cases, the DTI can actually change based on credit score, down payment, things of that nature. For this particular exercise, I'm going to be talking about conventional and FHA DTIs in the context of this. But let's go ahead and get started. Let's say you're making $120,000 a year in income, combined income, or just your income by yourself. And so that breaks down to $10,000 a month. So that's the salary we're going to be working with. So before I go any further, I want to discuss calculating your salary. So let's say you don't know exactly how much you make per year, and you want to do it per month. Make sure you pay attention to if you get paid weekly or if you get paid bi-weekly, or if you get paid twice a month. If you get paid weekly, you want to take your weekly pay, multiply it by 52, which is 52 weeks in a year. Take that big, fat, juicy number, divide it by 12, and that's the number you're going to use per month. If you get paid twice a month, the 1st and the 15th, you get paid on the same day twice a month, then you want to take that number that you get paid on your paycheck, multiply it times 24, because now you're getting paid twice a month times 12 months. So you're getting paid 24 paychecks per year. Take that number, multiply it times 24, divide it by 12, and you get your monthly amount. In that case, you probably could just take the same amount, multiply it times 2, and get the same number. But either way, and that's how you get your monthly salary. If you get paid every other week, bi-weekly, there are going to be 2 months per year where you get paid 3 times in the month. So you have to take your bi-weekly paycheck and multiply it times 26, because you get 26 pay periods in a year. Then divide that big, fat, juicy number by 12 to get your monthly amount. All right, so that's how you calculate the income. That's the first thing I do once I look at your pay stub. People will put in their income inside the application, but sometimes they're not accounting for getting paid more, especially if you get paid bi-weekly. You might be missing some money. Also, if you get paid some type of overtime or bonus, that income can be counted if you have a 2-year history. So when you're looking at your pay stub and you're calculating the income, if you're unsure if you can show 2 years of getting the overtime or the bonus or whatever that extra income may be, royalties, whatever it is, you may not want to include that when you're doing your DTI. Now you have your salary. You're at $120,000 a year. You're at $10,000 a month. And so that is the salary number we're going to deal with. Next, you want to look at your debts. So in a case like this, we have debts of, we have debts of $1,600. And I want to tell you how we got there. We looked at the minimum payment for the credit cards, which is actually number 2. So I'm getting ahead of myself. But you want to look at the minimum payment. I would suggest, to make sure you understand exactly the debts that you have, is to get you an account with like myfico.com. Look and pay for the, I think it's the mid-range, $30 a month, and get a copy of your credit report. It's also going to allow you to do monitoring as well. But you want to pull all of the debts that you actually see on your credit report, because those are the ones that I'm going to use. And so we're not going to count things like your light bill and your cell phone bill. Now, even if they show up in a credit report, we're not going to count those. But we're counting installments and revolving and things of that nature that you see on the credit report. And so the credit report is going to show the minimum payment, and that's the number that we use. So in this case, we had combined, I was going off a two-person household. So you had a combined income of $120,000. You had 2 cars, and combined the cars end up being $800 a month. We have credit cards for, you add up the minimum payments on the credit cards, and we get to $300 a month. The student loans. Now, there's a whole other video I'm going to end up doing on student loans. But for the sake of argument for this particular exercise, we're going to say the student loans are $300 a month. If your student loans say 0 on your credit report, you're probably going to have a conversation with your loan officer, because depending on the type of program that you're doing, it may be 1% of the balance. It may be 0.5% of the balance. It may make sense for you to have an income-based repayment plan, which allows you to use that number, because oftentimes a 0.5% or 1% really jacks your DTI up pretty high. And then the final thing is personal loans. So I've added all of these up for this particular exercise, and we have $1,600 a month in debts before we count the house. So for $1,600 a month, that particular DTI is 16%. That's just the bills without the house. And so now we see that the new house payment is going to be about $3,300. But we also have to count the insurance. So the house payment is like $3,300. The insurance is like $200. And so now we have a house payment of $3,500. So this $3,500 a month, this is what we call your front end DTI ratio. It is the ratio for just the house alone. And in many cases, you want to keep that front end under 35. There are some cases where it may go up to as high as 47. It really depends on the program. But conservatively, if you're in the 35% range, you're doing pretty good. And so now your front end is 35%, is a 35% DTI. And now we have what we call the back end. And so the back end DTI is calculated by adding in all of the debts, your debts plus the house. So $1,600 plus the $3,500. I should have had that bold. Sorry, y'all. So now we got $5,100 in combined debt per month. And so if we take the $5,100 and divide it by $10,000 a month, we get a DTI of 51%. Your front end is 35%, your back end is 51%. So when you hear people talk about DTI, oftentimes they're talking about the back end. What's your DTI? But you can have a situation where you don't have a lot of debt, but because you don't make a lot of income, your front end might be 50% and your back end is 50%. And in a case like that, you're probably not going to qualify because the front end is too high, even though the back end is too high. DTI is calculated by taking the expense and dividing it by the salary. You get a number. It's going to be less than 1, and then multiply it times 100 to get the percentage. So in summary, there are a number of ratios that are used by lenders depending on the program that's going to require certain ratios for your DTI. You want to make sure that you understand what your salary is. And then when you know what your monthly salary is, you're able to then calculate your expenses, divide your expenses by your salary, multiply times 100, you get your DTI. There could be certain expenses that are not counted towards your DTI. The house price that I have here of new house payments, $3,300. That is just, I didn't do any calculations in this case, but the house payment is going to be a combination of the number of years that you get the loan for, the interest rate, how much you put down, things of that nature. So there was a lot that was assumed in that line item. But in the end, that's how you do DTI, your debt to income ratio. Thank you again for watching my channel. Make sure to like, subscribe, notify. And in this case, this is I want to be very particular with this individual video. So also to make sure to give me some comments and let me know what you think. If there's anything that I should have covered or you would have liked for me to cover it differently. I tried to use numbers that were easy to follow. But I'm here for the party. Let me know if you got any questions. And again, I'm looking forward to sharing more content with you on my YouTube channel. Thank you so much for being here. Theme music.
Like 100 degrees, I got a fly chica Nathan, she's stunning with me.
I need water, 'cause this boy